Hello traders, you're welcome back to the Forex Geek channel. If you are still trading like the average retail trader using basic support and resistance or lagging indicators, then you are probably getting stopped out way too often. But what if I told you there is a way to trade like the institutions, the big banks, the hedge funds, the smart money? In this video, I'm just going to be breaking down smart money trading strategy for beginners, a simple yet powerful approach to help you understand how the market really moves. All right. So by the end of this video, you'll learn what smart money trading is and why it works. All right. You're also going to be learning how to spot liquidity grabs and stop hunts, and you're going to be learning the difference between retail trading and smart money concepts. And finally, you're going to be learning how to enter and exit trades using institutional order flow. So before we dive in, smash that like button and subscribe for more high-level trading strategies. Okay, let's quickly get started. Now, smart money trading is all about following the footsteps of big institutions instead of trading against them. The market is not random, okay? It is manipulated by banks and hedge funds that move billions of dollars. So retail traders tend to use outdated support and resistance strategies. They tend to get stopped out by fake breakouts, and also tend to chase trades after the move has already started. But smart money, on the other hand, smart money traders focus on liquidity grabs, understanding where orders are sitting. They focus on order flow, following institutional footprints and market structure shifts, spotting real trends. So if you can read these smart money moves, you can position yourself before the big moves happen, not after. Okay. Now, liquidity is what drives the market, right? Smart money traders look for areas where retail traders place stop losses and pending orders, right? So these guys, they look for areas where retail traders place their pending orders and their stop losses. Okay. Then where does liquidity build up? Above major swing highs and below swing lows. So when you notice notable swing highs and lows, just know that liquidity builds up around these areas. Okay, liquidity builds up around these areas. All right. So if you are to extend the areas, you're gonna see, you can see, right? Liquidity builds up around these areas. Okay. So you can see that these areas are coinciding. Can you see? Can you see? Around swing highs and lows, around support and resistance zones, we have liquidity building up around these areas. Okay, because market makers push price beyond these levels to trigger orders. All right. Another area of what's noting are round numbers and psychological levels. Okay, because big players target these areas for liquidity. Now here's how a stop hunt works. Retail traders enter a buy trade at a support, thinking it will hold, right? For example, let's use this example that happened around here. Okay, we can see that, or let me just go to a higher time frame, right? Let me go to a higher time frame. I'm just trying to look for a good example on the higher time frame. Okay, so we can see that we had, can you see that we have a support zone around here? You can see that, we actually have a support zone around here. Can you see rejection, rejection, rejection? But now, when retail traders enter a buy trade around the support, thinking that the support will hold, they might end up setting their stop loss below that support, right? Perhaps some pips below the support. Now, price dips below the support, triggering their stop losses. Imagine that set a stop loss around the price dips below the support, trigger the stop loss. Then smart money collects the liquidity, then pushes price back up. Can you see? So the real move begins after the stop hunt, not before. So if you don't understand this, you'll keep getting trapped. But if you do, you can enter at the right time, which is after the liquidity grab. All right. So you want to be looking for your buy opportunities after the liquidity grab. Okay. Now, let's just look at the differences between retail trading and smart money concepts. Now, retail traders rely on basic technical analysis, while smart money traders focus on how liquidity and market structure drive price. Okay, so as for retail trading, retail traders use indicators and lagging signals. Okay, while smart money use order flow and liquidity zones. All right, then retail traders, they fall for fake breakouts. Like you can see what happened here. Retail traders fall for fake breakout, while smart money wait for liquidity grabs before entering. Retail traders get stopped out easily, but smart money understands market manipulation. Retail traders react to price, but smart money anticipates price moves. So retail traders see a support level holding and jumping, while smart money traders wait for a stop hunt before entering. They wait for a stop hunt below support before taking a trade. So this is a game changer. If you wait for liquidity grabs instead of reacting to obvious levels, you will enter at institutional price points instead of getting trapped. All right. Now let's just talk about how to actually trade this strategy. Okay, let's talk about how to actually trade this strategy. So first of all, you have to identify a liquidity pool or stop loss, clusters at key levels. Then you wait for a liquidity grab or a stop hunt. Okay, price should spike beyond the key level and then get rejected. After that, you look for a strong rejection candle. You can see this rejection candle here, or market structure shifts confirming the real move. Then you enter after the liquidity grab in the direction of the true trend. Okay. Then for your stop loss placement, do not place your stop loss in obvious areas. Put it just beyond the liquidity grab, okay? Beyond the liquidity grab. Do not place it directly under your support or directly above your resistance, okay? Then for your take profit targets, your first target could be the next liquidity pool, all right? Your first take profit target could be the next liquidity, perhaps another resistance zone, right? The next liquidity pool. Your second target could be just allow your price, your position, allow your position to run, let the price just run, and then you trail your stop loss for bigger moves. Okay, so by following this, you will stop taking unnecessary losses and start trading on the same side as smart money. Now, some common mistakes to avoid include entering your trade too early. If you enter before liquidity is grabbed, you will likely get stopped out. Secondly, do not ignore market structure. Liquidity alone is not enough, so combine it with trend analysis. Okay, and finally, do not place your stop loss in obvious spots. Smart money targets retail stops. Okay, so hide yours beyond manipulation zones. All right, avoid these mistakes and you immediately see an improvement in your trading results. Okay, so if this video helps you, smash that like button and subscribe for more smart money trading strategies. Comment below, have you ever fallen for stop hunts before? Let me know your thoughts. Turn on notifications so you never miss an update. Okay, thank you for watching and I hope to see you in the next video. Happy trading.